Hey, everybody, welcome back to another edition of Market Talks with Dr. Stocks. This is Dr. Tom Carr, aka Dr. Stocks of DrStoxx.com, DrStoxx.com. And if you go to our website, www.drstocks.com, and click on the subscribe button, you'll be able to join myself and a big group of amazing traders in the live trading room. This is a service that's been offered for over 5 years now. And if you want to add on our brand new live options room together, you can do that at a discount. All right, so let's go to FinViz. I want to show our members of the room and those watching this on YouTube channel a little trick if you are interested in finding some of the new um, heavy duty, high paying dividend funds that have been coming online. There are several of them now. Some of them pay over 100% relative to the underlying price in dividends. Well, where are those dividends coming from? Well, they're not actually the old fashioned, a company gives away 2% of its income to subscribers to shareholders, not that kind of dividend. In this case, these funds are focused usually on a single stock. There is one that is a basket of stocks. They buy the shares of the stock and then they sell calls against those shares. So it's a covered call strategy essentially. And then the premium that is generated from selling calls week after week, month after month, are given back to those who own shares. And when the stock has been coming down and the fund itself is at a low price, those call premiums can be indeed very rich, and that's where you generate 100% or more in dividend premium, paid out sometimes weekly, sometimes monthly. Just be aware, there's nothing free in the market. It sounds like 100% premium is a no risk trade, but no, you can actually lose more than that in capital. So yeah, if the stock goes down 20-30% in a big drawdown, you can sell calls till you're blue in the face and you're not going to make that back up. So you will lose money overall. But in general, it's a pretty safe way of experiencing some nice capital appreciation overall, including the dividends in some pretty volatile stocks that have been really all the rage, right? So here's a quick way of finding those. You go to finviz.com, your one-stop shop for all things stocks, and click on the screener, and then click on this little ETF button here. And then here's what we're going to do. No, I'm sorry, don't click on that just yet. Don't do that just yet. Dividend yield right here. We don't have much option here. We want to see really high dividends, but we can at least put on this option here, this filter, greater than 10%. So everything that just passed through the filter there is going to pay out more than 10% per year annually in the form of a dividend. We want these to be fairly liquid. So we'll say the average volume, I don't want to weed out too many, but let's say 200,000. Okay, and current price, we'll just put this at 5 because I know that there are several in the lower price range. We don't want to weed those out either, so we'll do that. And then we've got a list here of 25 both stocks and ETF funds that satisfy those requirements. We're not interested in most of them. So we're going to go to financial and we're going to find the dividend column right here. And we're going to click on that so it sorts the highest to the lowest. This, I don't know what this is. This is a biotech stock paying out over 1,000% in interest in dividends. I have no idea what that is. It was probably some kind of a one-off thing, a share deal. So we can leave that one behind. Fiat is not it is a fund. It is coin. Okay, let's take a look at this one, Fiat. So this one is currently paying out 341% in call premium sold. And this is a play on coin. Now, you're not going to buy this in the hopes of the price going higher and higher. There are funds where when the dividend is paid out, the price of the underlying goes down, and that's what's happening here. So you're going to lose money on your overall investment, but you'll make it back and then some with the dividends that are being paid out. This pays out a monthly dividend. It looks like it pays out about $10.40 per year. It's like 90 cents per month. So if you have a 500 shares of this, you're going to get a nice monthly check of $450. That's not bad, right? That's not bad. So this percentage will change as the price of the underlying goes higher or lower. You're going to see that percentage go higher and lower. But the amount of dividend that's being paid out is probably fairly stable. I'm sure they have some sort of a system they're using to figure out the right strike price and how much delta value, how much intrinsic value to put into the calls that they're selling. And also, we should note that, of course, call premium will change over time as well, depending on how volatile the market is and interest rates and other factors. The Black-Scholes model, right, for option pricing, and that's going to change over time as well. So $10.40, you may not always see that every year, but it'll probably be pretty close to that, right, inside of a pretty narrow range. And so there's one that you can think about. I'm not sure I would recommend that one, but the one I'm in, if I can find it here, it's not even on my list. Why is this one not on my list? I'll just put in the ticker symbol ULTY. So this is a Yield Max Ultra option income strategy. You can see that it actually does allow for some price increase, right? It was down here in the $5 range, and now it's up in the $6 range. So there's a little bit of price increase. So this is an interesting thing. It doesn't trade a single stock like the one with coin. And there are those that trade MicroStrategy and those that trade Moderna, and there's another one that trades Tesla. But this trades as a basket of stocks, and it's an interesting basket of stocks. They're all great growth names, momentum names, meme stocks, Reddit type stocks. So you're going to find in here stocks like Hood and Reddit and ASTS, the satellite play, and a bunch of others. And so it's a basket of stocks. You're going to be able to reduce your risk through diversification that way. But again, do not buy these for the share price increase. You're not looking for capital gains here at all. In fact, your expectation should be that you will lose on the capital gains basis, but you will make that back and then some with the dividends. And this one pays weekly. Used to be monthly. Back in here, it pays weekly. You can see this, all these little dividends here are weekly payouts, and it's paying out $7.42 per year. So what is that, 65 cents or so per month. So it'd be about, I don't know, 15, 16, 17 cents per week. And if you have, say, 1,000 shares, you're going to make a little nice check of $150, $160, $170 a week from this position. Okay, just wanted to let you know that that's out there. I'm not recommending these at all. This is the one that I happen to have. I'm also in one other, which is MSTY, I think it is. MSTY. Yeah, so MicroStrategy, or now called Strategy, is a play on Bitcoin. I like the idea of having exposure to Bitcoin. We're long Bitcoin in every which way you can imagine. And so this is a play on the company that is buying Bitcoin, selling their shares and buying Bitcoin, and building this huge asset base in Bitcoin. As long as Bitcoin is stable and keeps going higher, this one will do okay. I've actually had a bit of capital increase in this one, but I'm not in it for that. I'm in it for the 122% annualized dividend. So this pays out quite a bit more, right? It's a higher price, but 27 or so, it's a bit more than $2 per month. And this pays out monthly. So if I have 200 shares, I'm going to be making $400 and something per month as a nice little paycheck. Okay, enough about that. Let's jump over to some charts. So let's go to indexes first. Now, there hasn't been a whole lot going on in the indexes. They've been pretty quiet for 6, 7 sessions in a row. After hitting all-time highs, we're in a nice little base here. Let's see, 1, 2, 3, 4, 5, 6, 7, 8 trading sessions. According to William O'Neill, to be established as a proper base, you need 3 weeks minimum. He prefers more like 6 to 8 weeks. but 3 weeks is the minimum to call it a base. It's not just a base yet. It'd be more like a bull flag or a tight little pennant. But regardless of what it is called, it doesn't really matter. The good news is this is a bullish formation on top of a very bullish run. In fact, from the April 7th low to the new all-time high that we had last week, we were up over 25%. I don't know exactly what it was, 26, 27. Not the best return in that space of time, and that's not a lot of time, but it was the second best return in all of market history. I'm pretty sure I'm right in saying that. It was historic, right? Really, really strong return. Now, after you get such a strong return, which is an anomaly, it pushes the price way above moving averages and far away from the mean. And so you tend to cool off a little bit for a while as prices discount future risks and discount maybe some overvaluation and on and on. The higher the stock market goes, the greater the risk. Traders don't generally like risk. And so everything has to consolidate for a little while. Now, that said, I do think that we're lining up here for another leg higher that will likely come. We've got some catalysts coming down the pike. So we've got CPI tomorrow. I think it's going to come in pretty cool. I've been thinking about this and reading some predictions about it, and most people are thinking the same thing. It's not going to exceed expectations. If it does exceed expectations, then they're using some old data that they shouldn't be using, because the current data right now, according to Truflation, which is a good follow on Twitter, we're at a CPI of 1.7%. Annualized, right? So 1.7% year on year is the current set of data points on consumer inflation. Last time we looked at CPI a month ago, it was 3 point something, right? Quite a bit higher. So, we don't want, what are we expecting for tomorrow? Let's take a look here. So we go to FinViz again, homepage, scroll down, look at the economic data. We're expecting, this doesn't tell me, I'm sorry. This is only month to month. To get I'm not going to do it now because we'll waste our time, but if you go to MarketWatch, marketwatch.com has a nice list of economic data both for this week and for next week, and it gives you all the price points, all the data points that are available. So for CPI, you get not just month to month, but year to year. Okay, it should be in the low threes, somewhere 3.2, 3.3. And I think if we're in line, we will be okay. If we're below that level, we'll rally sharply. And if we're in line, probably a modest rally. But, given that we've had this historic run off the lows, given that there's still a lot of tariff uncertainty out there, and also we've got big earnings coming up. It starts this week with the big banks, this week and next week, and then we start getting everybody else reporting. The mags are 2 or 3 weeks down the road, but we'll still get about every week now. We're going to get some major readings on how companies are actually doing in the actual economy, and that's hugely important. All right, so still, prediction for the S&P is maybe a couple more days of some back and fill, some sideways price action, tight and choppy, breakout coming very soon, maybe as early as tomorrow. The Nasdaq is doing the same thing. It's not quite as robust after breaking out of some recent. You can see the S&P is a fair bit above, further above, right? Its breakout point. Nasdaq is a little closer, but and the base that we're working on here has been developing a little bit longer. This is more of a 10-day base than a, what did I say before? 8 days. So a couple more days in here. And the Nasdaq has been doing this. It's been weaker on the way up. And right, you can see here is a little bit of a base. Here is another tight, rather long-winded base. And now we're again in a sideways churn kind of market. So with this sort of market, it's very good. It's bullish. It's not in any major danger of coming in swiftly, or we're not going to see a big 2-day drop down to the 50-period moving average or a multi-week drop down to the 200. That's just not in the cards. There's nothing in this chart that tells me that's going to happen. There's nothing generally in the economy that's going to tell me that's happening, unless we get something out of the left field that we just don't know about. That is always the risk, right? But right now, we're in good shape. So I had been thinking that the small caps were going to be much weaker than they have been, right? That little day right there was a 3-bar reversal. We had some short we had TZA on in the live trading room. That didn't work out, stopped us out. I kept a little bit of the M2K and I got rid of that this morning on the gap down. So I'm flat, small caps right now. And I took a little bit of a loss on that as well. But it's just kind of doing some slight trending higher, right? And I have to say, of the 3 major indexes, not looking at the Dow, this is showing us the most bullish setup right now. So I'm not so sure we want to go long the small caps unless it's just a really short-term trade. It's not the best kind of setup right here, but it's not a short anymore. If you're short the small caps, I would recommend doing what I did this morning, which is getting out of it. So gold has been flagging some bullish posturing, bullish setups here. Here's a nice reversal in the pink zone of an uptrending LRC. Here's another nice reversal pink zone of an LRC. It gets a couple of days of follow through and then it's right back down. A couple of days of follow through and it looks like we're going to get another coming back in. So I think gold is kind of torn between a safe haven play against a weak dollar and play against inflation against a desire to not take a safe haven and go right into some of the riskier things. And so gold has been a great trade for months and months and months. Here it is up at all-time highs and it's way above former all-time highs. But it looks to me like gold is starting to lose its luster as a safe haven play, and maybe that's a good thing. Maybe the market doesn't need a safe haven play anymore. If we do get a cold CPI tomorrow, that should help gold because it tends to put the Fed into more of a cutting posture than a hawkish posture, and gold likes a weak or dovish Fed. But we're not there yet, and yeah, I don't know. I want to go long gold. I really do, but I just don't see the bullish thesis for it yet. We were in a nice silver trade over in the options room. We had on calls on AGQ, and we got in down at this little pocket pivot setup right here. Right, it's down, up, down, up, down, up. Good volume, then boom. So we bought here and we rode it all the way up. Took some profits last week on Friday, and we took some more this morning on the big gap up. And we're out. We're flat silver right now because of that big reversal bar. Okay, oil is coming in quite a bit. We were long energy with ERX last week. We took some smallish profits on it. I had a string of losing trades in the energy sector, so I kind of wanted to just put something in the bank, and we did. We sold into strength on Friday, and I'm glad we did because it's a reversal, bearish reversal today at the 200. Bitcoin has been our big driver of profits in both rooms. We're long 5 or 6 different trades related to Bitcoin, including IBIT, MBT, the micro E-mini. At least I'm long that. Instead of IBIT, I'm long that. I have a little bit of IBIT as well. We're long some calls in the options room. We've got calls on MicroStrategy. We're in MSTX, the leveraged version in the live trading room. So we're just every which way you can trade Bitcoin, we're in. I really want to hang on to this, but I do think that it's probably going to cool off for a little bit. The best case scenario is just some sideways consolidation, allowing the valuations and everything else to catch up. But here's the thing. More and more companies are buying Bitcoin as an asset. More and more companies are using Bitcoin as a payment system. You've got a crypto summit going on in the White House sometime soon. I think it starts tomorrow, if I'm not mistaken. And then you've got governments plowing into Bitcoin in huge numbers to bolster their own economies. And boy, if that catches on, that's just huge. I would not be too surprised to see by the end of the year that this doubles, right? 250,000. 250,000 for Bitcoin is very reasonable given those trends and as long as they continue. So I would really like to hang on to our Bitcoin plays, even if we have to sit through a little bit of some give back, because I think we just want to be there. We don't want to be out on the sidelines when it has another big run like it's had in the last 3 4 days. Okay, so that's all I wanted to do on indexes. Let me take a look at some of the stocks in my greens list. So I'm waiting for MU to kind of figure out whether it is topping out here and is going to come back in, test the 50 or something, or whether this is just a flag formation off of a really nice run. So MU, I talked a little bit about MU in my IBD Live appearance a few weeks ago, and it's an old play, right? It goes back to the 1970s, I think. It's been around for a long time, and they are moving into AI data centers. Um, their memory, mostly memory storage and stuff, but they're expanding the product line. They've got a really good product coming on that will help the infrastructure of AI. The problem they've had, and you can see the problem reflected in share price over here, right? Big drop down, drop down, drop down, drop down, drop down. That all reflects the fact that MU had a lot of old inventory that they couldn't sell very well at current prices, so they had to lower their prices to get rid of the inventory. Well, they have now worked their way through most of that inventory and they're beginning to ramp up their new product line, which is much higher price point and much bigger margins. So all good for MU. It's just that I have a feeling that it might be leading the way a little bit lower here. So I'm just going to watch. This one, GRAL, has had a nice pullback all the way to the 50. It was printing a hammer candle earlier today. It looks like it's weakening a little bit. It's not exactly a good setup. It's not a perfect setup by any means because that support line there is broken. But we could trade this for a little bit of a backside bounce up into the bottom of that line, and that would get it up to the upper 40s. And here it is at 39. So I think this could do something like that. This is a tight float, heavy short kind of position that really tight likes to squeeze. So Crowd is a cybersecurity play. Got another downgrade today. I think the market's not in tune with. I shouldn't say the market. I think analysts are not looking at this one correctly. But I'm not smart enough to know why they're not. But they keep downgrading what, in my mind, is the number one or number two ranked play in the cybersecurity space. I know there's more competition now than there used to be. That's been hammering things like Palo Alto and some others, Fortinet also. But this is just you just have to be in this space. I'm in Fortinet. I'm in Crowd as long-term holds in my family fund, and don't want to sell them anytime soon. Been in them for a while. So it got a downgrade. It gapped down, and I said in the live room, I bet this is a buy to dip moment, and sure it was because it was opening right at the 50-period moving average, and it was pretty much all upside. Now it's come off a little bit of the lows of the highs here. Let me see. Keys is a nice, very good, robust company, and it's doing this little consolidation right here. And it's getting to the apex, and we kind of want to see that break out to the upside. I would wait until it does. Not exactly a buy right here, but it's extremely good fundamental company. It's one of those companies that doesn't make the widget, it makes the machine that makes the widget more efficient. And whatever the widget is, it's some sort of high-tech thing. And it's a great company. It's been around for a while. Okta came up. I use this software that triggers that gives me signals on interesting technical setups that historically through backtesting have had really good returns. And this one came up on one of those filters today. I'm not exactly sure. It came up on the buy the dip. The buy the dip is the name of the filter or the scanner. So I'm not exactly sure if it's just because it's down, or are there are technical things that they use, right? So RSI and stochastics and trading ranges and movement away from the mean and things like that. So could be all of those are triggering. But we've got two big slams down. We've got a reversal bar today that is a classic reversal bar. So let me explain what that means. Um, this is as good as it gets. So you get a bar that opens up within the body or the range of the previous day, goes below the low of that day to take out at least 20 days of lows. And this looks like 60 days of lows or 50 days of lows. And then rallies back up to close within above the open and close within the range of the previous day. And that's exactly what it's doing. And I don't use candlesticks very often, but this is one that I would pay attention to as a reversal pivot. Now, I don't think this is just going to go gangbusters. It's probably going to get back up here, 97. From 92 to 97, you could leverage that with some 90 calls, right? Hood, we have calls in the trading room and the options room, and we got in on that little bar right there, inside day within the wedge, and it's been all upside ever since. I do like Reddit. It's a I don't do Elliott waves, so if this is incorrect, don't shoot me. Don't shoot the messenger. But it looks to me like this is probably the pattern that it's following. It printed a big wave 3. Here's your wave 4 pullback into the 21 period moving average, and now it's starting to move higher. Looked a lot stronger this morning than it does right now, but I do think it's probably going to get back up here to get above the highs of wave 3 and print a reversal somewhere around 170. Okay, let me take a look quickly at two of the fun stocks to trade. CoreWeave, it did do a first level Fibonacci retracement. I wanted to talk a little bit about this tool, and I will just a minute. And that's maybe all that you're going to get as far as a pullback in this really big IPO. And it gapped up, and it's holding the highs of the day pretty well. So it's an inside day bar at the end of a long downtrend. I don't see anything wrong with this other than the selling pressure coming down was pretty steep and the momentum and price was steep. But maybe that just knocked out a whole bunch of new guys, and now the professional money is starting to pile in here at the 38 fib retrace. Circle is a similar kind of thing. It came down a little further. It got all the way to the 50 retrace, and it got down there a few days ago, rallied up, hit the 38, and has come back down. Now it looks like it's going to rally again. This is an inside day bar, which tends to be bullish at the end of a downtrend, like that one right there. And it is one of the most popular trading vehicles these days, Circle. We saw in the black box stocks that there have been quite a few calls, some big size calls coming in today. So let me take this off, and I'll show you how we work with the Fibonacci retrace tool. So the Fibonacci retrace tool, I've mentioned this several times, but it never hurts to go over things again. Where's my arrow? Right here. Okay, so you've got uptrends and you've got downtrends, and then the uptrend usually hits a peak of equilibrium and starts to cool off a little bit. And then the question is, where do I buy that pullback? Well, you can use moving averages. I like to use the 21 EMA, the 50 SMA. Between those two, if you get it's anywhere kind of between those levels, it's a pretty good place to start building a long position. To be a little more precise, to be a little bit more mathematical, and nothing wrong with that, because the best traders in the business, like Jim Simons, traded only on mathematical relationships, then you can use a fib retool. So here's how it works. You start down at the bottom of the uptrend, wherever the very last pivot low is prior to it going higher, and pull the indicator all the way up to the top of that uptrend. And as you do that, you're going to get these lines kind of halfway up that uptrend. starting at Fibonacci levels. Fibonacci, you know, the Fibonacci numbers 1, 2, 3, 5, 8, 13, 21, et cetera, et cetera. And the first Fibonacci level of any great significance is 38. And then there's the 50 level, which is kind of like not necessarily a fib number, but it is a key level. 50% retrace of the uptrend is typically about as far as you're going to get in a good bullish market. But if it dips below 50 to 68, which is the next level down, sorry, 61.8, I call that the money zone. And I'm not alone in thinking this, but I do think that a lot of professional money makers and algorithmic program traders and those that program the programs, they key off these retracement levels quite easily because it's just a very easy way of doing it. You just type in the number, and you know you're going to buy some at the 38, you're going to buy a bit more at the 50, you buy a bit more at the 61.8, and so you typically at those levels you start to get these bounces, right? Because the buy programs start kicking in. Now there's no guarantee that it's not going to keep going down, but you've taken a lot of the risk out of the trade. You're not buying the top for sure, and you're not waiting for it to go all the way back down to the bottom. You're expecting this to be a retracement or a pullback only, and then a return back higher. So the same is true for a downtrend, right? You can take your Fibonacci retracement tool, start at the top of the downtrend, pull it down to the lowest pivot low, and you're going to get some levels where you can buy on a relief rally. I'm sorry, not buy, sell short. You sell short up here on this relief rally. Okay, so that's how you use the Fibonacci retracement tool. And then if you want to put it on, let's see if we can find something here that, other than those two guys, this might trigger one. Okay, so there's always a little bit of a trick. Where does the uptrend actually start, right? So it, you know, way down here is the April low. Then it went up, and then it came down again. And then there was a nice rally here that went, you know, pulled back already. You don't want to include those pullbacks. You want to get a rally that is really pretty much going in one direction. So I don't know. We could put the beginning of that rally here, but then you have this little sideways base. How about this one right here? Let's call this the beginning of the current rally. We pull it all the way up to the top. And now you can see that Datadog has pulled back into the buy zone below 50 and above 61.8. Also coincides with the 21 EMA, which is your short-term momentum indicator. And I like the fact that it is printing a nice big green bar today. Now the volume is very light, but I think it's pretty light all around. And this is a, you know, per the Fibonacci indicator, this is a good place to buy. Let's see if we can find something else. SMCI is not really pulling back. I know Hood is not pulling back. Okta pulled back too far. How about ARM? Yeah, here's a good one. Okay, let me get rid of all this other stuff. All right, now the trick is, of course, finding the new uptrend. I would say that's your pivot low right there. So let's start with that pivot low, pull it up to the intraday high. And you can see as of today, ARM, fairly new IPO in the semiconductor space with some very good analyst support, pulled back into the buy zone and rallied right back out of it again. So this looks pretty good. I have to say, this looks even better than I like than the Datadog. You are below the 21, but you're above the rising 50. You are at the midline of an uprising LRC, and we flushed it out of the buy zone. So it got into the buy zone. Algo programs kicked in and rallied right back up to pretty much where it opened. And that's a nice looking hammer candle or reversal bar. And it is, if it just can close above the open today, that would be a classic reversal bar right there. So yeah, I'm going to say ARM is ready to go. Datadog, a little bit less bullish, but yeah, that's also ready to go. What was the other one? Circle or CoreWave? Yeah, they're both kind of ready to nibble. All right, guys, I'm done with everything I wanted to say. I'm going to stop the recording here and then take just a handful of chart requests, and then we'll wrap it up. Let me just close out here. God bless everybody. Have a great rest of the afternoon. We'll see you over in the live trading room. If not, go over to drstocks.com and sign up from there. Bye for now.